Good morning, everybody. Welcome. This is Mauricio Salinas with Elite Capital U doing a pre-market review for today, September 4th. I gotta check the date. It's still too early and I haven't had any coffee. Can't believe I haven't had any coffee yet. But yes, we are going to be doing a quick pre-market check so you guys could see how I prepare for the day. This is what we teach. And you're gonna see that it's a little different probably from what you're used to seeing. I'm not gonna be scalping in a 1 minute chart. I'm definitely gonna be scalping on a tick chart. We have a very holistic view of the market. As a prior institutional trader and a prior owner of a proprietary trading firm, we kind of take a look at the intraday market a little different. We are always looking for opportunity. We're not so much trying to make a buck. Get in here, get out, get in here, get out. 2 to 3 good trades a day is really all it takes. And once you start going into the lower time frames, I don't have anything against it. I do know, we do scalp. When the market doesn't, present itself for scalping opportunities, that's what we do. And but that is not all there is to the market. There is more to the market than just scalping, than just looking at a quick charts and looking at candlesticks and looking at wicks and that kind of stuff. Am I going to talk about that? Absolutely not. Do I know about candlesticks? Yes. Do I trade off candlesticks? Absolutely not. Main reason they're not quantifiable. Quantifiable in a sense that is very, I want to say very hard, not impossible, because anything is possible nowadays with technology. But mostly on the higher time frames, candlestick patterns can be more predictable. When you're looking down at the lower time frames, 5 minutes, 1 minute, 2 minute, it's a little harder for these patterns to be quantified because they move so fast. And realistically, when you're looking at time, just like a time base of whatever it is that you're doing, if you're looking at a 5 minute candle, it doesn't matter what happens. Once that 5 minutes stops, a new candle is going to form. So you're going to have patterns that maybe tell you what's going on in the market. Maybe you're going to have patterns that are just being formed because every single candle is cut off at a specific time, being 5 minutes, 1 minute, 2 minute. So it's very hard to quantify. When it comes to the higher time frames, monthly, weekly, and maybe even daily, it is a little more predictable, probably the word. But no, we do not trade off candlesticks. Like I said, I know all the patterns. I know your haramis, your dojis, your engulfings, all that stuff. I guess the stuff that we all fall into when we start learning this business of trading. But no. I've been doing this for over 15 years. Before that, I was investing long term. So yeah, everybody's had a trading journey. Basically, what you're seeing in the screen right now, these are basically your trusty bar, your bar chart. I will change it to candlesticks because I know that a lot of people are not familiar with the bar charts. They're more familiar with candlesticks. So here we go. All right, pre-market review. I know people hear a lot about, thank you guys for joining. Give us a like, give us a follow. We're going to be here every morning doing pre-market trading. And then after that, I will be trading live in the chat room in our webpage. But this is free for you guys. I mean, we don't. This is something that I like to do. Anyway, there's a lot of this information when it comes to this business, and the reason being is that it's a lot easier to teach and charge for teaching than it is to actually make money trading. So, we're giving a little back. I feel that some stuff should be free. Some stuff you definitely should pay for. A lot of people don't appreciate what comes easy. You appreciate it more if you actually have to pay for it. But believe me, most of the information that we give out here is free. And like I said, we've been doing this for over 15 years, so apparently it does work. Anyway, pre-market trading. Biggest misconception, whatever the pre-market is doing is what the day is going to be like, and that is definitely not the truth. Pre-market is basically what happened in Europe, in the Asia section, in the European section, what happened in Germany, what happened in the market in England. And this is something that has to be looked at all complete because we're in a worldwide economy now. There is no more, just the US or just Europe or just Asia. All these markets are combined. And we look at the futures market, specifically the ES, the S&P 500 futures, because this is one of the products or the product where companies come to lay off risk. What do I mean by lay off risk? Companies are always invested, and they're invested to the upside. Can they liquidate when the market is going down? They can, but they don't. By law, they have to be invested. They do have cash reserves that they need to keep, but they need to be invested all the time. They have a fiduciary duty to their investors. They have a fiduciary duty to shareholders. So, hey, they got to keep pumping money. You guys got to crank. Oh my God, I can't believe it. I have my coffee yet. So if you see me yawning, I apologize about that. So how do we lay off risk? Let's say, for example, if you have a position going to the upside, and for whatever reason the market decided to tank that day, well, they use the futures market, specifically the S&P 500. We can buy contracts, we can sell contracts. We can go long when we buy, we can go short when we sell. So if the market is going lower and you're invested to the upside, which institutions are, you mitigate that risk, meaning you cut off the risk, or you try to make it smaller or less by selling futures contracts. That's what the futures contract is so important. Well, as they call it, it's a futures contract. They have different prices, different expirations, and we're going to be doing classes about futures and options later on if this experiment goes well. This is an experiment. Let's see how it goes. But the ES futures, most important contract to look at. Institutions use it, and it's not for scalping. Trust me, we don't we don't use it just for scalping or to try to make a quick buck. It is a risk mitigation tool. Why? Well, 500 biggest companies in the US, the blue chips. So this is pretty much the backbone of anything that has to do with the market. So the first thing that we look at in the morning, obviously we're going to be looking at a market with the extended hours. I'm going to say it's gray. I'm a little colorblind, so if I say color names that you guys don't recognize, don't laugh too hard because I am a little colorblind. So this looks kind of gray to me, maybe a different color. This is your pre-market session. The ES futures, they basically closed yesterday around, let's say here, 64, 61, 26. 6 o'clock open in Sydney. It's about 1800 hours right here. Then you have your Asia Open. Then you have then you have your England Open. Then you have your DAX Open in Germany. So what do we see? I mean, we had a slow drift to the upside, but there's really not much going on, because if you compare this to what happened on Tuesday, we're pretty much in the same range. So the market has pretty much done a lot of nothing this week. If you remember, we opened with a huge gap to the downside on Tuesday after the holiday here. And if we look at this without the extended hours, this is basically what I'm talking about, the gap that we saw right here. It's not that nothing happened and the market just fell out of bed. It's because, well, voila, that's what happened in the European market during the night. Something happened at 3 o'clock in the morning when Germany opened and the market said, nope, we're out of here. And it just fell down. So that's basically where your gaps come from. Basically, it is all activity that happens in the European market. And we check it because it matters. It matters because a lot of this, for example, when the US opens, Europe is still open. So whatever they do there does affect us here. Does it mean that the market is going to keep doing exactly what Europe was doing? No. Why not? Because you need to understand that not everybody trades the European sessions. Institutions, specifically here in the US, they do have a trading desk all over the world. But the liquidity that is needed for a lot of these institutions to move the orders that they have pending, that liquidity comes during the US market. It is the most liquid market, it is the most liquid hours. So it's going to be from 9:30 until 4. You're going to see a rush of orders when the market opens at 9:30. There always amateur hours, not amateur hours. There's orders that are pending. order blocks that are pending. People are closing positions, people are opening new positions, because in this market you can get either too long or too short. So that being said, Europe, Asia, whatever you want to call it, the pre-market is pretty much a dud. There's nothing being done. So what does that tell me about what to expect for the day? Well, the main thing that you need to look at is, where are we? And if you look at these lines on my screen, this, here we go with the colors, funky looking line here, like a purple, like a whatever color you want to call it, that is a settlement price from last week. What is a settle price? Well, when it comes to futures and when it comes to a lot of products, you have what you call your closing price, which is the price that a lot of people look at and say, well, that was the last price, but that is not necessarily the case. What you're going to see here is that we do have what is called settlement prices in the futures market, and that price is important because after the futures market closes, there is an adjustment period where positions that are open are checked via computer, algorithms, to make sure that they have the margin required to stay open overnight. Margin requirements vary from the trading hours, the cash market. They do vary into the night, and a lot of the brokers do require a full margin. What do I mean by a full margin? Let's take a look. For example, let's look at what the margin would be for you to trade. And of course, Thinkorswim is not doing it today. I hate you, Thinkorswim. They do it sometimes they don't do it. Usually when it wants to work, you would come to Thinkorswim and you would put on your futures contract. You will pull down this little window, you go to the futures tab, and right here is going to tell you tick size, tick value, and margin requirement. But since it doesn't want to do it, we're going to do it the hard way. What is the margin requirement to buy a single contract of the S&P 500? It is not $6,469. That is the current price. For you to be able to place an order in Thinkorswim right now, you would actually need $24,402. That is called your initial margin. That is how much money you would need to have in your account to trade this product with this broker. Yes, there are discount brokers which will allow you to trade a futures contract with as little as $1,000 or even $500 in your account. Do I recommend that? Hell no. Futures market are risky. Futures market move quick, and small accounts get blown out of the water all the time. So when it comes to margin, what happens in the overnight when the market closes here at 4 o'clock, around 4:15, 4:30, futures market slow down, and they do what is called a mark to market check on the accounts, and all those accounts that do not have enough margin to the full margin, because it is required, but most brokers, the overnight margin is required at $24,000. If we're talking about the ES, those positions get closed, and either is what they call a margin call. Either you put in the money in the account to keep the position open, or the broker will close it for you. And whatever price the position is at the moment, that get closed at that price, and then that's also going to make the closing price or the settlement price fluctuate from the closing price that you see. So for example, the settlement price for the ES futures yesterday, Wednesday, the settlement was 64.57.25. So 64.27.25. Let's see, that's going to be roughly, I'm just eyeballing this. We're just going to fix it right now. 64.27. I'm sorry, 64.57. Yes, I am a little dyslexic, so just bear with me. 0.25. Does that look about right? Yeah, and then that was the settlement for yesterday. We're going to say that was at 1600 hours, give or take a few minutes here and there, it doesn't matter. And yes, I am very particular with my lines. So it's going to be 9.4, and we're going to say that this is going to be a settle until the market closes today at what time? At 1600 hours. Yes, the market closes at 4, but Thinkorswim uses military time, so there's that. Okay. And so, and of course, we're going to give it that funky color because that is the color of my settlement, and that is dot line. So that is the settlement price for yesterday. So 1500 hours, 1600 hours candle. The closing price for that candle was 64.6125. The actual settle, where the last contract was settled after all the margin and the mark to market was done, was actually here, 64.5725. Why does this matter? Well, as you can see, the price didn't fluctuate, 18, 1830, 1900 hours. The price actually stayed off the settle. So when we close, market open, bam, we slept into the settle. You see how it came down, Sydney open, and it kind of respected that level the whole night. So it is important to trace your levels. It is just more important to know which levels to trace, okay? What else do we have? If you guys have any questions so far, just, put it in the chat. I will be looking down at the chat, once in a while when I remember. Like I said, I'm new at this, so I do have to remember to look at the chat. So first of all, the settle. What is the second thing that we're looking at when it comes to the pre-market? Like I said, nothing happened. It's a whole lot of nothing. Up, down, up, down, up, down. This is chop. And what I look at, the next thing that I look at, I go to see what the activity was at night, especially on the ES. I look at how many contracts were traded, because that gives me an idea of who was in the market. If you can see here, this is the active contract. As you can see, we have many different contracts with different days to expiration and different prices. That's what they call them, futures contracts. The one that is active now is the one that expires in 15 days. That is the September contract. And there was a whooping 101,000 contracts traded. What does that mean? It means that whatever I am seeing on the screen is being validated by the volume. Because remember, in this business, you have your price. We trade with the adage that price is an advertising mechanism. Price is just another indicator. And I know you guys were taught to just follow price, follow price, follow price, follow price. We do not. We follow value. We follow volume. We look at momentum. That's what we look at. That's the way that we trade. That's what has worked for us, and that's what we teach. Volume, 101,000 contracts. That means the market is asleep. Something is happening today, and I think we all know what it is. We're going to look at what the news are going to be in a little bit for today. But 101,000 contracts is already 820. On a good day, on a day that you expect movement in the market, on a day that you say, you know what, maybe we have something going on later, or something that's happening in Europe that is moving the market, you should see around 250,000 contracts being traded overnight. Maybe 200 is a good number. When I see 101,000 contracts, it kind of gives me an idea that we may be looking at an inside day. Inside day meaning a range day, or I don't know what else you guys call it. We call it an inside day. That's basically what it is. Basically, a market is going to stay in range within two levels, and we're going to talk about those levels later on today. The other market that I look at when it comes to volume is your bond market, specifically your 30-year bond. Why is the bond market so important? Because that is where the actual real money lies, in the paper. When I'm talking about paper, I'm talking about your bonds, your notes. What's a note? Something that the government issues that is 10 years or less in duration. What is a bond? 11 years or more in duration. That's the reason. Anything shorter is also called paper, or they call it notes. There's also another name, I can't remember what it is for the ones that are like 1, 2, and 3, and 5 years. But we'll talk about that later when we do the class on bonds, because we will be talking about bonds. It is a very important market. Again, active contract, 111,000 contracts. This is actually moving. And you say, wait a minute, you said that the futures on the ES at 100,000 contracts was sleeping, it was nothing. But now you're saying that 111,000 contracts on the bond market is actually moving. Yes, it is, because it is a different size market. The bond market is big. It is very, very big. It is bigger than the stock market, and we will talk about that later. Maybe not today, but I don't know, the time when we do a class. So this kind of gives me an idea where the money is being placed, and that's what you want to do in the morning. It's not so much follow, well, what did the price do? Well, the price went up, the price went down, the price went up, the price went down. We got a bunch of dojis, we got a bunch of haramis. No, you need to figure out where the money is going. You're going to be like a Fed. Follow the money. If you follow the money, you make money. Well, if the Feds follow your money, you're probably going to end up in jail, but we don't do anything of that here. So I don't see any money being in the futures market. I see a lot of money being placed in the bond market. That means that somebody's probably buying some insurance. Usually on a normal market, on a regular market where nothing is going on, the futures market or the stock market and the bond market do not correlate, meaning that they go opposite ways. If the stock market is up or the futures market is up, usually the bond market should be down. If the bond market is up, then that means that the stock market or the futures market should be down. Why? Because the bond market is used a lot as a hedging tool. What is hedging? Hedging is another word for insurance. Investors are always hedging their bets. Like I said, an investment company that has $30, $40, $50 million in assets and is managing their money, they cannot simply go and sell because the market is falling. They hedge with the futures market. They insure those positions that way. We do have news coming up in about 5 minutes or so. And let's see what do we have for today. That is the other thing that we look at. So we already looked at the activity in the overnight. We traced what the settlement price was. We looked at the volume for the ES. We looked at the volume for the bonds. Yes, and I am making notes because you should have a trade sheet every morning where you keep your notes so you don't go crazy like what I like to call like an ostrich on crack, just going crazy on a 1 minute chart looking for where to invest. Okay, 11 minutes. We're going to have non-farm employment change, ADP. Then we're going to have your continuing jobless claims. That's coming up in 26 minutes. Look at that. Then we're going to have, let's see, make sure that I'm looking at that. Yeah, so for Thursday, September, let's see, non-farm payrolls, non-farm productivity. Let's see what else do we have. S&P Global Composite. I mean, that's pretty much, we have manufacturing orders coming in at 10 o'clock. So we have natural gas storage, non-manufacturing prices. Oh, look at that, 12 o'clock, Mr. Williams, FOMC member speaks. Fed balance sheet at 4:30 and the Atlanta Fed GDP. Okay, so why do we look at news? I know a lot of people get stuck at watching, MSNBC, CNBC, and these people did this, this company did that. I personally don't trade stocks. I hate stocks. That's full disclosure. The closest that I will come to trading a stock is going to be an ETF, like the SPY or the Qs or the Russell. The Dow Jones, I do not trade the Dow Jones. It is, what's the word that I'm looking for? I really don't want to offend anybody if anybody trades the Dow Jones. It's 30 companies. I mean, come on. Do you want to follow 30 companies or do you want to follow what 500 companies are doing? Those 30 companies that are in the Dow Jones, they are in the S&P 500. And there's also a big difference in how that index is calculated as opposed to the Russell, the Qs, and the S&P. Again, we'll have classes on that later to see how different indices, how they work, and how they're measured. But the other issue is liquidity. When I talk about liquidity, we're talking about volume. The more people, the more institutions, the more activity that you have in a single product, that means that it's going to be easier to get in and get out. That also means that you're going to have narrower spreads. What is the spread? Everybody knows what the spread is. If not, the spread is the difference between the bid price. Let's see, the bid price and the ask price. What are you talking about? Well, let's look at something like the SPY. We have news coming up. I know I'm getting off topic, but I just want to show basically what this spread is. The spread is the difference between this number, the bid, and this number, the ask. If you see here, the at the money is 143 to 144. What does that mean? That means that you have a 1 penny wide spread. When it comes to the options market, you need to multiply it times 100 because you have 100 stocks that are guaranteeing or they're backing that options contract. You are not buying the stock when you buy an options contract. You're only buying the contract, the option to purchase or to get filled with that order at a later date based on the strike price that you chose. Liquidity, SPY. It is the most liquid market in the world, bar none. Nothing comes close to it. Not Apple, not Microsoft, not Nvidia, not Tesla, the SPY. One penny wide spreads. Why does it matter? Because when you buy one of these contracts, your spread is 1 cent between the bid and the ask. Remember, you got to multiply it times 100. If we look at something like Chipotle, I hate this stock. This is with the market closed right now. This is the one that expires today. Let's look at it right. You're looking at 89 to 94. That is a 5 cent spread. 94, am I right? No, that's 89, 90. Yeah, that's about a 5 cent spread. Again, I haven't had my coffee, so just bear with me. You need to multiply it times 100. It may not seem like a lot of money right now when you look at it, but when you start adding up the cost of trading, which is your commissions and your spread, because that goes against whatever money you made or it gets added up to the money that you lost, it does make a difference at the end. So whenever you're looking for a product, you need to look for liquidity. The more liquid the product, the smaller the spread is going to be between your bid and your ask. Now, we were talking about news, and there's something coming up right now. Why is the news important? The news is important because we're not looking at what the market, a lot of people try to predict, oh, it's going to go up, it's going to go down. And you guys are all infatuated with price movement. We really couldn't care less what the market is going to do because the market is going to do what the market is going to do. Liquidity. You need liquidity. You have your spread. And I lost my train of thought. What the heck was I talking about? We were talking about, oh, somebody help me over here. We were talking about the news, and then we talked about spread. So the spread is important. Let's see, we have news coming up. We're talking about, let's talk about levels. What else are we looking at? We're going to look at the news. And what we're looking at is so much, it's going to be the reaction to the news. A lot of people try to predict the market's going to go up, the market's going to go down, the market's going to stay sideways. A lot of times when this news is economic events is what we look at. We don't look at MSNBC, we don't look at all these channels. Probably the only channel that I would look at to see what's going on, and I do that early in the morning as soon as I wake up, is Bloomberg. That is probably like the only thing that I would trust to be unbiased. A lot of the media companies are owned by a lot of the same companies that have a vested interest in the stock market. When we talk about indices and exchanges, you are going to find out who owns what, and you're going to be like, what? Yeah. So mainstream media, I don't pay attention. They create a lot of hype. They create a lot of nonsense that really has nothing to do with trading. Bloomberg is probably the only thing that I would look at. I find them very unbiased. But I do, we look at economic events. What's happening in, for example, jobless claims, unemployment numbers, GDP numbers, manufacturing numbers. It's funny because I'm gonna tell you something. 10 years ago, nobody cared about those numbers. Nobody cared about GDP numbers. Maybe the closest thing that we would look at was, unemployment numbers. And that was pretty much it. Everybody was more interested in earnings news and what was going on. That would actually move the market. After COVID, with inflation and everything that's been happening, those numbers seem to have a lot of weight on the sentiment that investors are going to take. So that's why we look at it, because we're looking at what the reaction is in the market. Did the market take it well, or did the market take it not well? And you will see that sometimes bad news will move the market higher. Good news will move the market lower. everything has to be taken into context. Why is this market reacting this way? The why really doesn't matter if you're like a short-term trader, like a intraday trader, or maybe a swing trader. I mean, a swing trader, it might matter. But the why is not so much important. I want to know what the reaction is. We're going to find out about the why later. Another thing that I want you guys to understand is the market has a flow. It has like this drift. In whenever you have news, or whenever you have earnings, when you have something that disrupts the market, it's only temporary. That's only going to be temporary for maybe 20 minutes, half hour, whatever it may be, depending on the news event. But the market will continue doing what it was doing before. When it comes to earnings, yes, everybody wants the earnings call. Everybody wants to know what the market is going to do. I can tell you with a very small degree of error how much a company will move on the earnings announcement. It's already premeditated. It's already not premeditated. It's already baked. It's already baked in the sauce. Trust me, institutions don't trade money in a vacuum. They don't. Okay, we know how much a product is going to move based on the options market because 95, and I would probably say almost 99, but let's say 95% of what gets traded today is options. Why? Because believe it or not, there is not, and again, not an unlimited amount of shares to go around. Every company has different amount of shares on float. What do you mean on float? Well, this. How many shares does Chipotle have on float? Let's see, that looks like, actually, this is why this price went up, because these people used to only have like 800,000 shares at one time. So now they have 1,340,185,000 shares. That is all that is available. Those shares are invested. They're not just floating around sitting in somebody's desk. Oh, what do I do with this? So what do I do? If this is invested to the upside or whatever investment strategy institutions have, well, guess what? We need to trade options. That's what they do. So trust me, when it comes to earnings, when it comes to all these events, we have an idea, what they call binary events. We have an idea what's going to move. So let's see, Apple. Everybody loves Apple. Oh, Tim Cook. Look at that. 14,840,380,000 shares. That's it. That is a lot of shares. But guess what? Those are already handed out. Somebody owns them. They cannot just go and dump the shares in the market because they will just dump the price. This number is highly correlated to the price of the stock. And when we do the classes in stocks, which we will do in the future, we will talk about more about all these numbers, the volume, the open, the high, your beta, all this good stuff that that you should know, not necessarily because you're going to trade it, but knowledge is power. The more you know, the more valuable you are as a trader, as with anything else. So let's see, 8:30. A whole lot of nothing happened. Nothing is happening in that candle. We're looking at a 30-minute chart. What is the next thing that we look at? So we kind of make a list of the events that we're going to have during the day. Like I said, we're going to have our Fed speak. Fed speak is important because a lot of the times when we get the news from the Fed, interest rates are going to go up, interest rates are going to go down, blah blah blah. Once that Fed meeting, which is one of the catalysts that everybody should be aware of, whether you're a day trader, where you're scalping your brains off on a 30-second chart and just scalping away, doesn't matter. You need to be aware of at least that catalyst. You should know when Powell speaks, everybody listens. But we only get to see what he said. Well, up, down the rates? No, okay, the business is the same. Then half an hour later, once we see the reaction to the market, which is a big, like a big blip in the market, like if you're having a heart attack, then we get to listen to the press conference. And he does his little dance around and, we might raise them, we may not raise them, we're looking at the data, we're data driven, blah, 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 blah. It's all the same song and dance. What does matter is the minutes when they come out 2 weeks. I think it's like 2 weeks later, the minutes come out from those meetings. Those the market looks at because they digest them. I mean, they basically look at every single line because they need to get an idea what the Fed is thinking. So when these people when the Fed governors speak, like we have been talking to the, what was it, 11:30, I think was when this guy was going to talk. Hold on, let me check. I don't want to lie to you. Where are you? Where is this guy talking? Your refinery, crude oil, heating, blah, 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 blah. Oh, Williams, he speaks at 12:05. You listen. You make it a point to maybe not be in a position, maybe kind of have, maybe kind of take a breather and just wait to see what he has to say, because believe me, investors do listen to these guys, and so should you. Like I said, doesn't matter what your Fibonacci says, doesn't matter what your what your strategy says, doesn't matter what your your candlestick says. When these people speak, if they say something that the market doesn't like, you will see a reaction, and more than not, it's probably going to be against whatever you have open at that moment. Again, it's only temporary because the market will kind of adjust itself again. All right, so we looked at that. What else do we look at in the morning? I am looking at levels. What levels am I looking at? Again, this is a long-term level. This is the settle from last week. So that settle is being respected. We have the settle from yesterday. So we have right now two levels that you could trade off when the market opens. What do I mean trade off? You need to have a level of risk that you're willing to take. And the easiest way for you to measure that level of risk is by seeing what levels are important to the market. Trust me, the levels that you see, we don't see. I'm going to be honest with you. We do look at fibs. We do look at them in a long term. We do look at RSI. Again, momentum is probably the most important thing. But when it comes to trading, let's say intraday, let's say not so much scalping, but trading intraday, we do have a market internals, and we will look at those in a little bit. Those only work when the market is open, but we do look at market internals, and that does play a big part in our trading routine. Why? Because that is probably the only thing that moves before price is your market internals, and again, momentum is the only thing that moves before price does. So if you are directionally biased, or if you're hooked on direction, then market internals is something that you should really be learning about and be like an expert on, and also momentum, because momentum will move before price. Again, for us, price is just an advertising mechanism, because we look at the market like what it is. It is an auction. It is an auction. Market goes higher until the last person that was willing to buys, and then market's going to come down looking for buyers again. The market's selling off. Market's going to sell off until the last person that needed to sell sells, and then it's going to come up looking for sellers until it finds buyers again. It's an up and down motion. It's like the bunny chasing the carrot. We do look at value, and we look at later on we're going to look at how we look at value. So again, levels. If I'm gonna, let's say for example, quick example, I have this yellow line, which is yellow. I mean, I'm pretty sure that is yellow. Looks yellow. That is my weekly pivot. We do look at pivots. Weekly pivots are important, especially when it comes to scalping. Why is it important? Why is a weekly pivot important? Because being that it is a higher time frame level, is going to take a lot of strength for it to be broken by the market if you're like during your intraday. It is a level of liquidity, meaning that there were, for whatever reason, there were a lot of trades placed there. So yeah, so there is going to be some interest when it comes to the level. Obviously, now you know why the settle is important. There is a lot of money that was either placed or closed at that level, okay, and the settle for this morning. So when it comes to risk mitigation, do I want to take a trade here in the middle? Not necessarily. I mean, I won't. Why? Because the market is all about probabilities in, probabilities, deviations. It's a very mathematical place. It really, when you look at it, it really is. And when if you're looking to place a trade from here, you basically have a 50-50 proposition. Market's either going to go up here, or market's going to come down and touch my settle again. Do I really want to take that 50-50 shot? No. I need to have a little more, what's the word that I'm looking for? A little more confirmation. I would like to have a little more confidence in what I'm going to take. That's probably the word that I'm looking for. So if I have a market that is trending sideways and I see that this level is a higher time frame level, is a settle, market is going to respect it. I feel safe for taking a short here because I know that if I'm wrong, what is my exit? Well, it's going to be my weekly pivot. It has nothing to do with highs or lows or the wicks or whatever. It is my settle and it is my weekly pivot. And for whatever reason, as you can see here, the market does respect it. Oh, but that is market structure, is higher high. Look, it's all about levels. It's all about liquidity because this levels is where your liquidity is where your trades were placed. Okay? So, what is the place of less risk and higher probability? Here. If I'm wrong, that's my exit. So I will be risking 72 to 75. 34 points to what? To make, let's see, how about, I don't want to count, it's too early. You're risking 3 to make 15. That is one hell of a risk-reward ratio. See, that's how we look at things. I really don't care what formation this is. I really don't care if it's a higher high, higher low, whatever it is. I am looking at risk mitigation. Problem that a lot of people have in this business, especially the newbies, is they want to learn to make money. I want to make money, I want to make money, I want to make money. Guess what? The first thing that we teach our traders is how not to lose money. If I teach you how not to lose your pants trading, guess what? You will make money in the long run. Because if you know how not to lose $5,000, how not to lose $10,000, how to mitigate your risk, how to trace the correct levels in your chart based on volume, based on liquidity, that's what's going to make you money. Because look, everything in the market works until it doesn't. And that's one of like those Murphy's laws. You know, when something's going to go wrong, it's going to go wrong. But guess what? In the market, that is true. Anything that can go wrong will go wrong, especially at the wrong moment. That is the adage, for our business. It's going to go wrong, and it's going to go wrong, especially when you're in a position where you can have it go wrong. So, settle. The other thing that we're going to be looking at overnight highs, overnight lows. We already have those. 8 o'clock open is very important. Why the 8 o'clock open in the morning? It's about 8:20, 8:15 to be honest with you. But we're not gonna be too picky. That is when the bond market opens in Chicago. And remember what I said about bonds. They are bigger. They are bigger than the stock market. That's where a lot of the smart money is, if not all the smart money. There's an old saying in Wall Street, you want to know where the market is going to go listen to the bond traders, because that's where the big money is. So market opens at 8 o'clock, 8:15. That's why I'm looking at the market since 8 o'clock in the morning, because I need to know what those people are doing, what their reactions are. So that open is very important as well. The other thing that we trace for the day that I trace, or that the people that trade here, are going to be your daily risk markers. What is a daily risk marker? Again, nothing is done in a vacuum in this business, and we have 15 minutes left because we're going to cut off at 9. The options market kind of gives you an idea of what the move is going to be for the day. What they feel is, not so much they feel, but where the money is invested, there's always a top and a bottom. And the options market gives us this number. I'm going to give you a perfect example. Why do you think that when we had the drop on Tuesday morning, this was the 2:30 in the morning, that was the pre-market for the DAX for Germany. Look, we came to touch this level to the T. We slammed against it, bounced, took a while for it to be broken down, 6:30 in the morning, 7, 8, and as soon as the market opened, 9:30, we tested again. It's close enough to test it. Came back down, went back right inside of it. There's two reasons why. This, if you see this DRM, is called, stands for daily risk marker. That was the market, that was the risk that the market had for Tuesday. That's what the options market was saying. This is what we what we're dictating, the market is going to move based on the money that is invested. These levels have nothing to do with technical analysis. In the past, this has nothing to do with Fibonacci's or any of that crap. It has everything to do with options liquidity, what the options market is saying that is going to, what the risk is. Again, 1800 hours and that was on Tuesday when the Europe opened. We came down and we slumped against it again. We came up again. That was your regular 300 hours high. High. What is it? We settled exactly at the same place. That was the risk marker for yesterday. Very small risk because the market contracted. But guess what? We didn't go below it. All right. So what is the market saying that is the risk for today? We have exactly $54.40 from yesterday's close. That is what the market says that we should be moving today. Is it going to happen? Could be. If the market is very quiet, but remember, just because the futures market is quiet in the morning doesn't necessarily mean that is exactly what's going to happen in the regular cash hours. So what do? We're going to take our closing price, which is 64.6125 and 54.40. That gives me a 65.15.65 market for today. So let's see. Duplicate this. We're going to edit this, and it's going to be from 4 to 4, and it is 65.15.65. 65.15.65. And we're going to click OK. So my higher marker for today, my risk level for today is going to be, the top is here. And let's say what the bottom is. Let's see what the minus 54.40 minus 54.40. 64.685. We're going to duplicate this one. Oops. Edit that one. And done. 64.6. 64.6.85. All right. 64.6. So what do I have? Right now, what I just created, what the market tells me, the options market is telling me that the market for today should move. Is it giving me a direction? No. But it's nice for me to know that if I'm in a long position for whatever reason, let's say the market opens and 9:30 the settle doesn't get taken out, well, maybe I'll take a long. What's going to be my first target? That will be the settle for the week. What's going to be my second target? Because it's going to bounce up and down, up and down, up and down through here until it finally breaks off. Then guess what? Next target is going to be the risk marker from Wednesday that wasn't touched, and then from there is going to be the risk marker for today. Remember, these are zones of liquidity. This is based on the options market. This has nothing to do with technical analysis. All right. So that is the next thing that we do. I trace my risk, whatever the market is telling me that no, don't risk or draw. It's just this one. Thank you. All right. Now, the other product that we do look at, when it comes to basically planning the whole week and seeing what the actual institutions are doing, we look at the SPX. What is the SPX? Well, the SPX is the index, the S&P 500 index. Why do we look at the index? Because this is the most, let's say, I don't want to say expensive because I hate to use those words expensive and cheap. There's no such thing in the market. It is the biggest product. It is what they call the mother of all products. It is a huge product to trade, and I know a lot of people love to trade 0 DTE on this product, and you have no idea the razor blade that you're playing with. I mean, this thing will humble you very quickly if you don't know what you're doing. If you're thinking of trading this, I wouldn't do this with an account that has at least $50,000 to $75,000, if not at least $100,000. Why? Because this product you can only trade. If you see here, you cannot trade an index. You cannot buy or sell an index. You see the buy and sell buttons are gray out. This is a product that you can only trade with options. So let's see how much an option of the SPX is worth to see how big it is. Well, look at this. So this is the one that expires today. Your 0DT. Let's see, I want to go long. Oh, bless my heart. Look at that. That one is only $1,600. That single little option is $1,600. That's what's going to cost you. Okay. So like I said, this is a big product. It is huge. So be very careful if you're going to be trading this. But the reason why we do this is because the institutions do trade the SPX. Mostly, specifically, they do sell a lot of our contracts in this. Why do institutions sell contracts instead of buying them? When you buy an options contract, you have a directional bias. You're either going to be going long or you're going to be going short. That's just the end of it. When we sell contracts, we have a specific range that we need the market to stay within so we can collect that premium every single day. As you guys know, when you buy a contract, an options contract, you're on the clock. The minute you bought that contract is losing value because of the theta component of the option. We have Greek components in options. So pretty much when you buy a contract, that position has to start working for you right away. You really don't have time to lose. And I know people tell you, buy time, don't be cheap. Guess what? It doesn't work that way, because whenever you buy a lot of time in an option, then the implied volatility component of that option is what's killing you as well. Okay? So when we do the options class, because we will have a beginner's options class, and then we're also going to have advanced options classes coming up in the future, we will talk more about that. But specifically, why the SPX? Risk is laid here, and there's trillions of dollars being invested, being traded every single week by institutions. If you see these lines that I have on my chart, all-time high, because everybody should have their all-time high in the chart at all times. There's no excuses for not to have it. If you see this top green line, let's say use green, and you see the bottom red line, those are the risk markers that the SPX market is putting on the market for this week. What does that mean? It means that this is the highest that it should go based on the money that is being traded, and this is the lowest that it should go. This is all, again, this is all based on liquidity. It has nothing to do with what happened in the past. This is not based on technical analysis or Fibonacci's or what is it that people love to do now? Crap, I forgot the name of it. Your fair value gaps, all that crap. This has nothing to do with that. This is, let me put it to you like this. Technical analysis, you're always looking at the past. Always. Doesn't matter, you're trying to make predictions, because everybody's trying to predict what the market's going to do. You're making predictions based on what happens in the past. The options market, when it comes to implied volatility, when it comes to risk markers, when it comes to liquidity and volume, is giving us an idea of the expectations for the market in the future. So if you're infatuated with movement, why don't we look at the options market instead of looking at the past when it comes to technical analysis? Oh, because it works. Look, like I said, everything works until it doesn't. But I would rather know what my risk is going to be in the future than look at something in the past and then cross my fingers, hopefully that it works. Why do you think that when you get a prospectus from the institution or anything that has to do with investment, they tell you past results do not equal future performance? Because nobody knows what's going to happen. But the options market is the closest thing that we have to giving us an idea what the expectation for the market is. And when you do understand and learn how to look at the options chain, and you learn to look at open interest, you learn to look at volume, we do get a pretty good idea where the institutions are placing themselves, whether up or down, whether going long or short. And that is like the little fish following the shark. If you learn to see that data, we follow what they do, and that's exactly what we do. Again, Tuesday market open. This is the risk marker for this week. Top risk, bottom risk, weekly pivot, settle, because the SPX does also have a settlement number, and that was the close for last week. It is no it's look, market open with a gap down, slammed against the weekly risk marker, and what did it do? From there, now it's coming probably to test the close again. Why did the market not keep going down? Everybody that was in the market on Tuesday believed that the market was going to keep going down because it was a huge gap to the downside. Yes, it was a huge gap. It was a move to the downside, and I saw a lot of people losing money because they thought that the market was going to keep dropping. If you would have had this little level on your chart, you would have known it's going to take a little more than that for this to break. Okay? More than not, remember, there's trillions of dollars in this little box. And what the algos do whenever they see the market coming out of these lines is going to do everything that it can to hedge and bring the price back inside. Because as long as we stay in here, all those options contracts that were sold, calls, puts, straddles, triangles, iron condors, all that crap that was sold, as long as it stays here within this week, they're collecting money. Because every single day that passes that the position doesn't work in your favor, the money is being collected. And even if it does work in your favor, you pay your theta every single day. Whether the market moves up, down, or stays sideways, you're paying for time. And that's how we make our money, collecting time. So risk is very important to know. So the next thing that I look at in the morning is what? Where am I between my risk markers for the week? Well, we open. Look at that. Is your hammer. Oh my, bless my heart. Hammer, hammer, hammer. Look at that. I'm going higher. And we're probably going to slam against the close of the week, and we're probably going to be testing this weekly pivot. So you see how I'm kind of making myself a map for the day. I'm not looking at the doji, I'm not looking at the harami, I'm looking at where the market, what the most likely direction for the market to be based on the levels that it needs to test. Because levels are like magnets, okay? The market goes from one level to another and from another level to another. And I have, oh, look at that, it's 9 o'clock. The last thing that I want to show you guys is how we look at value in the market. How do we look at value in the market? Well, I don't know if you're familiar with this type of chart. These are called market profile charts. We call them time, the time for the market charts, because when it comes to price charts, you only get a two-dimensional view. You either get just price and value. That's really all you get to see. You get to see an open, a close, a high, and a low, but that doesn't give you an idea of who was in the market. It doesn't give you an idea of what type of sentiment the market had. It doesn't give you an idea of value. And remember, price is an advertising mechanism. Price is going to go up and down, and people are going to be chasing it. Value is what matters, because you could have price going higher, higher, and higher, and higher, but if value is not following, that price eventually has to come down. That's just the rule. That's it. That's economics 101. Prices go higher, but if value doesn't follow, prices have to come down. Why value? Because not every single person has the same perception of value. What is this explanation? When somebody's looking, I don't know, excuse my French, somebody's looking at a house. The house for the seller, I'm selling my house is worth $500,000. That's what you think the house is worth. That's the value the house has for you. But then you look at the last 6 houses that sold down the street, and they're only selling for $300,000. Guess what? The value of your house is $300,000. That's what the market says the value is. Somebody might come and bid $350,000, $400,000, $450,000. But if the value is not there, you're not going to sell the house for $500,000. Same thing with the market. The market has people that drive the market up, people that drive the market down. But eventually, value is what's going to tell you where the market is headed and what the market is, the sentiment is. So, and yes, we do have classes on this type of charts. Whoever's interested, you guys will let me know. Send me a message. Again, value area. This little square that you see here. Very tight market for yesterday. Very tight market. Value area. It was a market that it was indecisive. No institutional trading activity whatsoever that we can see. And you say, how could you say that? It takes practice, and that's something that we teach. Let's look at the overnight market. See what it does. It was a very tight market. As you can see, if you compare the market This was Tuesday's market, all including the pre-market. This was the market yesterday. You see how tight it's getting. It's getting tighter and tighter. That means indecision. That means the market is waiting for something to actually make a move. And yes, here's your volume profile. And we use that completely different than what many people use it as. And we do have classes on that. Again, as I mentioned, your weekly pivots, your settles, they do have importance. Why? Because if you look at your ES, and where is my, here's your settle, here's your weekly pivot, and here are your trading markers, as you see. So there is a lot of congestion in this area, and the market, like I said, if the market is going to go higher, it's going to have a hard time breaking these two levels. Eventually, it should, but my proposition is that we're actually probably going to head lower instead of heading higher, based on everything that that the market is doing. Well, that is all for today. It's 9:02. Join us again tomorrow, 8 o'clock in the morning. We'll be here again doing pre-market. We'll talk about our market internals tomorrow, especially the tick, the advanced decline. We're going to be looking at volatility futures, which play a super important role when it comes to trading. We're going to be looking at equivalent charts, because the one thing that I do look at in a 1-minute chart is volume, not for trading, but mainly for volume, to see how volume reacts to different levels. Again, thank you for joining us. Any questions that you have, please send us a message, and we will be here again tomorrow morning at 8, and we'll probably do a couple of market recaps throughout the day to see what's going on. Thank you so much for joining us. Have a good day.